Hello and welcome to part 4 of my series of valuations. And for this section, I'm talking private equity and private loans. My Finance in 5 intro video gave a quick overview on valuations, and now, well, you want more knowledge because you're interested in finance and want to become a successful investor. Valuing private equity, well, is a subject beyond basics, so let's make it simple. Private in this case doesn't translate into secret, although it can when you sign an NDA or non-disclosure agreement that limits or restricts who you can share information about this company with, what they make, how they make it, or whatever else that makes them unique as something that they don't want shared. You are seeing the private information as an investor, employee, maybe a key supplier, etc. So as once you've signed this NDA, often a potential investor will pass at looking at a deal if they're asked to sign an NDA too early in the discussions. NDAs are serious documents, and they should be reviewed by experienced professionals before committing capital. How do I briefly explain how to evaluate a private equity investment in a few minutes when it takes months in college? Well, let's start with the basics and we'll build from there. So hopefully by the time we're done, it makes sense. The first thing, no matter what, is do you believe in the leadership team and their vision? If you don't, then in my humble opinion, it's a hard no. There's nothing to value, no matter how successful you think the venture might become. The reason this category is also called venture capital is because investors are often entering uncharted territory. New products, new services, new ways of doing something, etc. And all this new, well, it takes a lot of cash, which leads us to burn rate as a method of valuing private equity investments. Now, burn rate equals the negative monthly cash flow when you subtract expenses from any income. Most new ventures have little to no revenue, but they have an abundance of expenses. If you're asked to invest in a new venture and they are burning, let's say, $25,000 a month and with a $250,000 balance in the bank, then you can estimate that this venture will be bust within 10 months, unless they get new investors, positive cash flow, reduce expenses, or get bought out by another company. So either you're investing in 1, a sinking ship, 2, a business ready to break out, or 3, something that's positive transition ready for that next level, or 4, a new idea not really developed, more story than substance. Another tool I use to keep it simple for valuing private equity is the big pond analysis. Similarly, do you want to be a big fish in a small pond or a small fish in a big pond? The reality for me is how big is the pond and what a big fish might look like. I'm going to give you an example. Amazon getting 5% of the USA market for retail sales is huge versus a company that has 15% of the USA market for trout fishing lures. And by the way, my middle-class millionaire clients, they often own a small business like that fishing lure company. Serving any type of niche can make you very successful. Just ask the Garbanzo family or Andy Gump. The next method for simple valuation then becomes how big is this potential market in dollar terms? And if they were to achieve, let's say, 5% market share and maintain some type of good profit margin, then how much could this future fantasy company be generating in positive cash flow? Well, with this knowledge, you could see how much other companies of similar nature of earnings multiples have been sold for. This is another part of financing called mergers and acquisitions, or M&A. And it's not going to be covered too much in this video. But for many private companies, their exit path is not going public in the stock market, but often getting acquired as a private venture. Many times they're bought out by a public company. I'll give you an example. Cisco made 180 acquisitions under former CEO John Chambers. One of the many reasons a company might go public is to have cash or stock to offer in acquisitions. This worked out well for Google buying YouTube and Facebook buying Instagram. Of course, there are venture capital ideas that get funded, and you just question the logic of how much something becomes worth so much. To clarify a point and to also explain valuations, when I say worth, when I'm talking about a private venture, I'm often referring to the cap table, short for capitalization. This spreadsheet documents who has what ownership, debt, or equity with this company, issued or reserved. Then this number is tied to the latest amount someone might have recently agreed to invest in the company via loan or equity. And just because somebody says it's worth something, because that's what they paid for it, doesn't mean I think it's worth that much. So look at these colossal failures. WeWork.com, Pets.com, and so many other .com or tech companies. It's also been solar and energy, but there have also been winners like Beyond Meat and Uber. If you're interested in learning more about private investing, then stick around for my extended version. I'm going to dive more into the details and share some wisdom about loans, equity, and other aspects of this exciting area of finance. But please, before you continue, please exercise your finger onto the like and subscribe button and share with your friends you think can benefit from this knowledge. In the comments section, tell us what you like or how we can improve. I'm Ian Goldie. This has been Valuations Intro to Private Equity and Loans. In a financial career that has spanned 25 years, I've been witnessed or been asked to help in many conversations on personal loans and equity. Let me share some methods I use to evaluate loans. First, if I lose all the money, is it going to affect my ability to provide financial safety for my family or our daily lives? Second, is this loan going to affect the personal relationship no matter what I decide? As the advisor, often my goal is to extract myself from this conversation because, well, these are often no-win conversations for the advisor. If a client insists, then I will assist. Now, loans are easier than equity to value. If someone is asking another person for a loan, well, it's probably because they can't get a traditional financing at a bank or credit card. And if this loan is for someone that you love and you care about, then offer the loan at a rate that they would achieve at a bank, some good rate. I suggest the borrower be charged penalties for late payments, just like a bank would, unless, of course, the borrower asks ahead of time and of that due date for flexible payment terms and you're okay with these modifications. If the person does not think your terms are fair, then you may have a problem and should strongly consider not loaning the money. You're treating them with respect, they just don't know it, or they have some unreasonable expectation. Another tip when loaning money is don't allow the person borrowing money to use you personally as their jokes or snide comments. I've seen this fester into anger, being called this person's banker, loan officer, anything else that's not okay in my opinion, unless it's quickly followed by savior, friend, or anything that's highly appreciated. For those loans where there's a nice profit margin, then it's really more of a business. But remember, all loans can default, so choose a rate that would be lucky to get through other financial companies. LTV equals loan to value, and it's a common method for quickly establishing equity within an asset. Let me give you an example. If a borrower has a home worth $500,000 and they owe $300,000, then they have a 60% loan to value. Me personally, I don't like buying real estate loans such as first or trust second deeds with anything under 70% LTV as my bare cutoff. Here's why. If the borrower defaults, then it will cost a great deal in lost rental income, lawyers, court fees, possibly property repairs for those that didn't really care about the deposit being returned. I need at least a 30% buffer for potential drop in net value to cover these losses if I needed to take possession of the property because of default. Just selling the property costs 6% in commissions, so it only leaves you 24%. And the real estate market could change very quickly. In Southern California, we are only one big shake away from a housing price collapse. I lived in Southern California during the Northridge earthquake, and I knew some successful people who were multimillionaires the day before, and within weeks were bankrupt. They owned too many homes with tenants and also borrowed heavy on each property with very high LTVs. Then the earthquake caused massive construction damage, and many tenants left, and all the investors' equity was wiped out. Almost every first or second trust deed I have personally reviewed does not have earthquake insurance on that property. So this is an added risk to the lender. In my estimation, you deserve to be compensated for that risk when you buy them. As a very rough guideline, here are the rates I would suggest charging in this August 2020 environment for various types of private loans. Percentages range reflects quality of asset and the quality of the borrower's personal finance, their score. Residential, now you might get 7 to 8%, and just a few years ago it was closer to 9 to 12%. Multi-unit apartments, then those numbers should be a little bit higher. I would say 8 to 10% in today's market. Commercial property, that's very tricky. And in my opinion, most investors should avoid too many variables and best work with professional commercial broker. Undeveloped land in the desert has less value than an empty lot on Rodeo Drive. In this instance, I would say Beverly Hills is grade A and the desert location is a grade E. I would suggest you avoid loaning to raw land at all, but if you did, then focus on grade A or B. But at a minimum rate right now, I would suggest is 10% interest. A variable here is often a buyer of land wants the seller to carry back, it's called carry back, up to 10% of the loan. And this jargon means that the buyer wants a seller to loan them, acting as a bank to help complete the sale. Now, carryback loans for good property, I typically would suggest be structured as a 5-year or less loan. And to close a property, a seller might just have to offer something, needs to offer this carryback loan, and the rate might have to be something similar to the rate that they get the bank, or it could be higher. Hey Adam, I'm going to toss it to you so you could explain a couple more ideas for private equity and how it could help our viewers.
Thanks, Ian. I'd be happy to share with our viewers some tips we use for private equity research, and honestly, this is one of my favorite areas of business because this is usually the starting place for many innovative products and services, often led by interesting people. Like you, Mr. Musk, with SpaceX and Starlink, or the teams over at Stripe, Robinhood, Chime, and many more. We pay for a service provider named Crunchbase. Now, they're not paying us for this video, but our commitment to our viewers is to share what we like and why. With this service, we can filter for specific industries, certain leaders, or investors. Now, I mentioned SpaceX earlier, so let's take a look at what Crunchbase has to say about this company. This link shows how many rounds of investments they've accepted and the total funding amount. This also shows how the valuation has increased with each new round of investment, with the latest round valuing this private company at $5.4 billion. Another way we research is often by reading headlines indicating one company bought out another company. There's often a bit of detective work in finding out the details of the deal because those transactions are often complicated and the nuances are not readily available. I'm going to send it back to you, Ian, because we could spend hours talking about these interesting companies, and maybe we will in another video.
Personal equity, also known as sweat equity, can be valued two ways. Method one is your time and/or physical labor. The second is the leverage of your reputation and expertise. Let's start with example one, sweat equity. It could be a few people writing code together, fixing a property together, or some manner of time and physical actions. But if everybody values their time equally, then that might not make sense. For example, the financial brains behind a deal typically doesn't do the same physical labor, they do less, but often the deal can never get done without their unique skills. Look, you wouldn't expect the same hourly rate for a highly skilled litigation lawyer than you would a highly skilled drywall expert. In this example of lopsided job duties, it's best to agree what each person's time is worth and then keep a running total of hours. Agree before you begin. And I suggest you give ample time for all to consider before signing an agreement. Avoid hearing the phrase later that something wasn't fair or I didn't understand. Don't push back in anger, but educate each other for your concerns before you begin. Example 2 is harder to quantify, but I often see its misuse and misunderstanding, and it's far more valuable, sometimes than all the physical time and labor. And this is when we are discussing the value of someone's reputation. Without writing a single line of code or hammering a single nail, someone's reputation could be worth far more for a private venture. Let's say you know a friend or relative that is a former or current executive that is well known in, let's say, the tech industry. Now, this key person joining your company immediately gives the company an air of legitimacy, making it more attractive to get venture funding, attracts key hires, and builds strategic relationships. I've witnessed countless times a stock or new venture has jumped in valuation the day it's announced that a key executive has been hired. Now, this reputational value also extends to a key investor. Therefore, these key investors or executives will want more favorable terms, and they should get it if you really want their talent and reputation. Just watch a few episodes of Shark Tank and you quickly realize the power of the brand and its participants far outweigh their initial dollar commitment. My advice is not asking anyone you know for help, partnership opportunities, unless you have absolutely done your homework for understanding their value. Why insult a valuable contact because you did not understand and appreciate their worth? Invest in yourself by hitting the subscribe, like, and notification button. Check out our links for freebies and other info. I'm Ian Goldie. It has been my distinct honor in teaching you and sharing my thoughts on this important financial subject, valuations for private equity and loans. This has been the Finance in 5 Extended Edition. Check out the other videos in this series. Learn more. It's my fondest hope that I can help you become financially stronger and get you one step closer to turning your dreams into goals.